The Reserve Bank will announce its monetary policy on Friday, and it is faced with a Rajasthani thali of good news. I mean, every cup, economy, US interest rates, crude prices, political certainty, everything looks good. As always, the CNBC-TV18 Citizens Monetary Policy Committee is meeting to discuss what we can expect from the Reserve Bank and the MPC. How is policy made in good times? Joining me are Chairman of our Citizens MPC, Dr. Pronab Sen, and members Samiran Chakraborty of Citi, Sajjid Chinoy of JP Morgan, Soumya Ghosh of SBI, and Sonal Varma of Nomura. Gentlemen and Sonal, thank you very much for your time. Dr. Sen, I'm going to start with you. Exactly how will central bankers make policy when, growth is going gangbusters? You can't sound anti-growth, but growth literally means that there can be excesses, asset inflation. So what will be the overall messaging, you think, or what should be the overall message?
Well, the growth story isn't quite as good as the headline numbers make it out to be, Latha. The momentum is not great at all. In fact, it's weakish. And so I think growth is something that they will have to keep their eyes on. Inflation, of course, is looking under control, but there's some bad news in the offing. So I would imagine that the job of the MPC isn't quite as difficult as you make it out to be. I think they're going to have to manage both inflationary possibilities and try and build up the growth momentum.
Okay.
Otherwise, the growth is going to drop down very sharply in the coming quarters.
Okay. Let me see if there is another view on growth. You can find fault with the second quarter GDP number in terms of base and deflation, etc. But still, it's much stronger than any of our polls indicated. So what do you think the Reserve Bank is going to say about growth?
So, Latha, I think because the number has come out much better than any one of us expected, there is likely that RBI will have to revise its growth forecast marginally higher. But I would agree with Dr. Sen that if you look into the details of the growth number, it's a two-paced economy. There is the infrastructure, construction, manufacturing sort of, if you may want to call it, the investment side of the economy, which is doing much better. But if you look at the consumption side, that's much weaker. If you even look at the different proxy indicators of what we can call the informal sector within the GDP number, that has been surprising on the downside, actually. So it's a two-paced economy, so it's not that RBI would definitely be worried about this growth number. The peculiar thing is that growth is not leading to inflation because core inflation numbers have been exceptionally benign. So as of now, we are in this sort of Goldilocks scenario where we are seeing relatively high headline GDP numbers, but relatively low core inflation numbers. The problem is with food inflation, but that I don't think monetary policy can solve so easily.
Yes, there is that, but I'm just trying to wonder how central bankers react in an extreme Goldilocks position. But, inflation, there is still some worries. Soumya, what's your sense? Is the inflation trajectory all that benign, or is there some worry in terms of, food inflation? How will the trajectory look like?
Yes, I think on the inflation, I think the best of the numbers are over. In the current fiscal, you will get numbers which will be now 5.5% could be now the norm. In one of the months, the number could actually even cross 6% if you look at the base effect of last year. The vegetable prices are again going up. Onion and tomato are example. And the most important changes which we are looking into the food inflation today is that after a long time, the market prices and the mandi prices are significantly higher than the MSP. And also the ENAM markets. For example, in paddy, the prices at the ENAM market are higher than the MSP by 111%. And many of the pulses also, the prices are higher by 60 to 70%. So that gives us a sense that perhaps we are back to the days when there was a significant divergence between mandi and MSP prices. And as the point you just mentioned that the acreage is down by 5%, the acreage session is not over, but I believe that by December end we have to cover 60% because these crops have an around 12% weightage in CPI. So if there is any issues with this acreage, this could have an cumulative impact on the headline inflation. So from that point of view, I think we need to remain cautious because food inflation is still a concern and will remain a concern if we look into the trends of the price behavior in the market in the last couple of months.
Well, I want the views of the other members as well on growth and inflation, but also the global picture looks very different from what it was on October 6th when US yields were at 5%, now almost 75 basis lower. Sajjid, can you just draw the global perspective for us, which the MPC has to take into account?
Sure, Latha. I think one source of relief ending 2023 for emerging markets, the global environment is looking much less hostile. As you pointed out, US yields were close to 5. They're now below 430. The dollar index was 107. It's almost 4% lower. What's driving that change? It is the fact that the prospects for a soft landing that seemed very, unlikely 6 months ago have actually increased in recent months. And that's happening because even as everybody has been focusing on strong demand and strong growth around the world, and particularly in the United States, what surprised positively is the supply side has finally begun to react. If you look at labor force participation in the US, it's increased by 0.5% in 2023. Prime labor force participation today in the US is higher than the peak of the last cycle. So the supply side has finally begun to respond. Foreign bond participation has picked up. And what that's allowed us to do, Latha, is essentially you can now get stronger growth, but you can also get a softening of prices together. Think of the supply curve moving out. We've seen, despite job growth being strong, the unemployment rate in the US has actually moved up by 0.5% from 3.4 to 3.9 this year. Wages have begun to soften, and you're seeing core CPI in the US over the last 4 or 5 months, essentially on a monthly basis tracking below 3%. So from the Fed's perspective, this is as close to Goldilocks as you get, where you're getting strong growth, the labor market has begun to cool a tad, wages are coming off, core inflation is coming off, and because the supply side is doing a lot of this work, you don't need the demand side to respond. Now, this cycle has been strange in many ways. This is kind of weirdonomics over the last 3 years around the world. So we shouldn't count our chickens before they hatch. Things could change. But just ending this year, there's a little bit of relief that maybe, just maybe, 2024 may not see a hard landing. Growth will undoubtedly still slow. Make no mistake. Given where global growth is today, it will slow into 24, but perhaps not as sharply as one had feared. Last thing I'll say from India's perspective, even crude prices, which were above 90, are now below 80 because oil suppliers are struggling to coordinate. So lower US rates, a weaker dollar, lower crude prices makes for a much less hostile global environment than we had to contend with 2 months ago.
Absolutely. Sonal, can you put all the pieces together in terms of growth and inflation? Is the situation such that the Reserve Bank can therefore go to neutral because things are not so pressing?
Yeah, Latha, I think we are in a good place on monetary policy right now. Probably a bit too soon from a signaling standpoint to go to neutral. But net, I think given the development since October, there's a case for the RBI to raise its FY24 GDP growth projection. We think they'll raise it to 6.7 from 6.5. The inflation trajectory is panning out in line with their forecast, and while near term and particularly the next 3 months or so, we will see headline go up. I think the core coming down is a big comfort. As Sajjid said, globally things are less hostile, which gives us some comfort, but I think EMs clearly should not be lulled into complacency, and we need to use this period of calm to basically build our resilience and build our buffers. I think the important point is that even as repo rates have been unchanged, actually there is stealth tightening ongoing. One is via liquidity, where we have seen effectively rates being closer to the upper end of the corridor. And second, through the tightening of the risk weights, which is going to lead to some more policy transmission. So per se, we don't need to do much on monetary monetary policy. But one, on liquidity, I think we still need more clarity in terms of where we want system liquidity to be and whether MSF being the operative rate is what we want as a new normal. And second, I would say the last many quarters of low FX volatility, in our view, could be leading to complacency in terms of hedging activity for corporates. So we need to use this period of calm to basically build buffers even on this front.
Okay, now that's an important point, Sonal, you're making, that you may not have to keep the repo rate at 6.75 and they can bring it down to 6.5. I'll have to ask the other members that. All those questions lined up for the MPC members after this very short break. Welcome back to the deliberations of CNBC-TV18 Citizens Monetary Policy. I've been speaking with the chairman of our committee, Dr. Pronab Sen, and members Sonal Varma, Sajjid, Chinoy, Soumya, Ghosh, and Samiran Chakraborty. Gentlemen and Sonal, thank you very much for your patience. Dr. Sen, I do want to ask about liquidity and OMOs, but before that, one more piece that the RBI may have to contend with, the fiscal piece. With a bit of certainty in polity, you can argue that the governments will be more able to control the fiscal deficit. Old pension scheme and all perhaps may not come. On the other hand, this growth is because we have a 9% fiscal deficit. That's like an economy on steroids. So what will be the fiscal piece that MPC will take in?
Unquestionably, Latha, they will assume fiscal correction happening, and hopefully sizable fiscal correction. That has to be factored in. And this becomes important because if you look at the investment figures, in the absence of this increase in public investment, they don't look good at all. So the fiscal side will have to be taken into account because your entire growth story could change very quickly.
Okay. Yes, there is that. They will have to lower, and at the moment it is a bit of a capex-driven growth. Now, Soumya, let me come to you on that part. Given this very aggressive growth, do you think the Reserve Bank has to, and the MPC has to actually maintain the tight liquidity and the withdrawal of accommodation syndrome, or can they, take off?
The monetary policy continues to remain tight, and given the fact that when we last discussed, the Fed rates have actually gone up further. So from that perspective, I think the 6.5% rate the RBI is holding should hold. And also on the sense of liquidity, I think liquidity also, it will need to look tight, but at the same hand, it needs to look at liquidity very differently. But because now there's another story emerging on the liquidity side, when you have a continuous deficit liquidity on system, but continuous surplus liquidity on core, because the government is not spending. And this is going to be difficult in the coming days because the government may be actually moving to a just-in-time liquidity mechanism for releasing government balances. So on the whole, I think this needs to be looked into a more holistic approach. But for now, I think the Reserve Bank will like to maintain the withdrawal of accommodation and also at the same rate where they have been told for the last several meetings.
Okay. But even if they maintain that withdrawal of accommodation stance, last time they threw a bouncer with the OMO sales, which of course didn't happen. But Samiran, now there is a greater chance of liquidity. This political certainty will bring in, equity flows, and the bond index inclusion could bring in more debt flows. So do you think they will reiterate OMO? What will they say?
So two parts, Latha. One part is that where the current durable liquidity stands, which is around 2 to 2.5 lakh crores, whether RBI wants durable liquidity to be even lower than that. The other part is that whatever fresh durable liquidity is coming in through FX inflows or might come in over the next few months, how RBI would be sterilizing that. I think the answer to the second question is relatively more obvious, that RBI will have to employ measures like OMO sales, etc., to absorb that liquidity, to sterilize that FX liquidity. But whether RBI, before that flows comes in, tries to bring down this current durable liquidity of 2 to 2.5 lakh crore, that remains an open question, which I think Sonal was also hinting at, that the markets need some clarity that whether this durable liquidity is good, bad, ugly. And this will get reflected in the actual real question, which is that how much the banking system liquidity will, how long that will remain in the tight zone, how long the overnight rates will be 15-20 basis points higher than the repo rate. I think this is the signal that probably this policy will throw up from RBI, that whether they are comfortable keeping it this way, or now, given the changed global and domestic situation, they would want the weighted average call rate to come down to the repo rate again.
Okay. What's your sense, Sajjid? Stance, liquidity, and your take on inflation. I mean, ultimately, MPC's view on this will depend on their take on inflation.
Exactly that. I think this all comes down to what the MPC's view on inflation is. I think the good news is, core inflation is at the lowest in 43 months. We actually think core is going to come down towards 4%, maybe as early as January of 2024. So we made substantial progress on core, but I think it's too early to claim victory on inflation, given the multiplicity and the repeated food shocks with their amplitude. So if you look at, I know over the next 2 months, headline inflation heads back towards 6% because vegetable prices have spiked for the second time in 6 months, and the central bank should rightfully look through those vegetable price shocks. But if you look below the hood, what you will see is food prices, even without vegetables, have been quietly but steadily firming over the last 5 months. This is pulses, this is cereals, both rice and wheat. And so if I look at food inflation ex vegetables, take noise out, it's looking at, it's at 6.8%. It's been very close to 7% the last couple of months and will likely remain there over the next couple of months. There are question marks about kharif production. There are question marks about rabi sowing. So I think it's too early to say that the inflation problem is behind us when it comes to food. I think the RBI will rightly focus very much on food, mainly to see if there are second round effects, whether the effects of this repeated food price shocks are spilling over, into wages, into core. So hopefully, 6 months from now, the outlook will be more benign. But for the next 3, 4, 5 months, my sense is the central bank will be very closely focused on food price dynamics, and therefore will remain cautious when it comes to its rates, tone, or liquidity.
Okay. Sonal, what do you think they will want to communicate? Will they in some way communicate they're moving towards neutral and allow the rates, the interbank call rate to come down to 6.5? But do you think that they could worry about some growth excesses and do some of these macro prudential steps, raising risk weights on personal loans? Something like that can also come?
Yeah, Latha, I think on the first part of your question on liquidity and whether they'll allow the weighted average call rate to get back to the repo rate, which is actually the MPC's monetary policy objective. The reality is that the drivers of liquidity are not entirely in the RBI's control, and particularly it's been government cash balance going up, which has sort of thrown the liquidity calculations a bit off track compared to what was anticipated in the October policy meeting. Now, going forward, if we do get, our projections, at least till mid-Jan, suggest that banking system liquidity is going to be on the tighter side. Now, post that, if we get sustained flows in anticipation of the index inclusion or other factors, then that could be a point where we get into a more sustained banking system liquidity surplus and therefore potentially a trigger for OMO. But I think things are still way too uncertain. And from the central bank's perspective, they would want to have all flexibility in their hands. So I don't think they are going to effectively definitively commit to, saying we will or we will not, or rather we will not do OMO. So the option of OMO will likely still remain on the table, but in terms of the timing and how it plays out will depend on various factors in play. On your second question, Latha, on risk weights, I think we've already seen on the recent measure on unsecured loans and to bank lending to NBFCs. And if you remember, prior to that, there was also some tightening on home loan EMIs, borrower repayment capacity, which basically becomes effective 1st Jan 2024. So there's actually a lot of macroprudential tightening already in the pipeline. Some further tweaks are possible, Latha, but I think the FX hedging bit, particularly whether corporates are adequately hedged or not, that is one area where potentially we could, or at least the central bank should look into that aspect.
Okay, thanks for that. Actually, out of time, but Chairman, I want you to have just the last word. There are 4 tools the Reserve Bank has brandished. One is, of course, the stance, whether they would go to neutral. 2, this OMO. 3, bringing the call rate from 6.5 to 6.74. And there's, of course, risk weights on personal loans. What will be the bouquet they will give us on Friday?
Well, I think the sensible bouquet, whether they'll do it or not, of course, is entirely conjectural, is that, you really have to mix up the segments. The growth looks strong, but it isn't as strong as it's made out to be. They'll have to keep that in mind. They will have to keep the eye on liquidity, and particularly with food prices going up, as has been mentioned. So they can't let liquidity get too loose for whatever reason. So they're going to have to keep tight on that. And frankly, if I were in their shoes, I would personally tighten liquidity and actually reduce the risk.
Oh, right. Got that, sir. Thank you very much, members of the committee and Dr. Sen. It's time to vote. Well, first, let me start with you. The first question is, what will the Reserve Bank and the MPC do to interest rates on December 8th?
No change.
No change. Pause. Soumya? Soumya?
I think it will pause.
Okay. Sajjid? Pause. Okay, I think you're on mute. I could lip read you.
Pause, yeah.
Sonal?
Pause.
Okay. Dr. Sen?
Pause.
Okay, this is an easy one. Withdrawal of accommodation is the stance. Will that be retained, Samiran?
I think at least for this policy.
Okay. Soumya, what do you expect?
It will continue to retain withdrawal and accommodation given the current inflation objective.
Okay, same as Samiran. Sajjid?
Retain it.
Okay.
Retain the same stance.
Sonal?
Retain.
Dr. Sen?
I would move to neutral.
Yes, sir. You have held that view. I don't know how the Reserve Bank is going to manage that transition, though, as and when they do. Well, a quick third question. Will Reserve Bank change the growth forecast from the current 6.5? If yes, to what? Soumya, you say that first.
I think the Reserve Bank is likely to revise it upwards to around 6.8% or so.
Okay. 6.8. Yours?
Maybe around 6.7.
Okay. Sonal?
Raise to 6.7.
Okay. Sajjid?
Raise to 6.7.
Dr. Sen?
Retain 6.5.
Okay. Well, I wouldn't be surprised, sir, if they follow your advice. It's possible even they are prepared for good growth, but not so much good growth. Wrap up on this special edition of the Citizens MPC. Let's see what happens on Friday.